Good evening, I'm John Batchelor. This is the John Batchelor Show. Larry Kudlow, my colleague, co-host, and friend, is here from CNBC and Kudlow Radio on the weekend, and we are going to apply ourselves to the Affordable Care Act, Obamacare, and income inequality, and large themes that will once again take command of the conversation after the election. However, before the election, it is important to restate what it is that the Republican Party sees in the Affordable Care Act that is negative. Before we turn to that, however, Larry's here to comment on some unusual activity in markets. Now, Larry, you've taught me over the years that in October, funny things happen in the markets. And today, I was surprised to hear that the price of a barrel of oil was not 87, was not 86. It went down to 81. I don't know where it finished. This plunge, in addition to what is characterized as the biggest appetite for bonds, U.S. Treasuries, since the summer of 2013. Lots of money coming into the bond market, lots of anxiety about Europe. How does this all fit together, Larry? A very good evening to you.
Well, good evening, John. It's a very peculiar line of logic. And let me begin by saying, in my opinion, humbly and respectfully, lower energy prices, particularly crude oil and gasoline at the pump, are uniformly good for virtually every sector of the economy, with the possible exception of the direct energy producers themselves, the exploration people, who will get thinner profit margins because of the decline in prices. All right? Everybody benefits. But for some reason, the market, looking for a reason or an excuse to correct, has sort of grasped this idea that lower oil prices are bad. Number one, it shows a lack of demand and that our economy is crumbling. And number two, that lower oil prices are going to force a cutback in drilling and exploration and production, and therefore we won't be hiring near as much as we've been hiring, and there won't be secondary and tertiary effects from that hiring. Now, let me just say there's so much we could talk about and we don't have time. But I just want to let listeners hear this. Fracking is the big issue, and it's been a fabulous economic energy miracle, energy independence, okay? Our imports have fallen off substantially. We are now the largest liquid oil producer in the world.
Energy superpower.
Super. And now, you'd have to see crude oil drop, John, below $60 a barrel in order to stop the fracking dead in its tracks. I'll just use that phrase. $60 a barrel. Today it closed at $81, we'll call it $82 a barrel. I think that's highly unlikely. Some people believe the break-even point is $45 a barrel. We're at 82. We're probably coming down towards the end of this, may drop into the 70s. We are not going to see an end to the fracking revolution. That is my opinion. We are not. Nothing of the sort is going to happen. What is going to happen is that the rest of the economy gets a large tax cut from lower energy and particularly gasoline prices. I would estimate roughly now American motorists / consumers will save about $100 billion. It's already impacting us, so that means Christmas sales are probably going to be better than anybody thought. And outside of the energy producers, John, anybody else, stores, manufacturers, healthcare facilities, anybody that uses fuel, which is to say everybody in the economy, will benefit from lower fuel prices. So I am suggesting, my own personal view, is that people buy this dip. They buy this correction because in its wisdom, I think the market experts are giving people a bum steer. There's also a second point about lousy European growth and that may spill over into the United States. I'm not going to deny that might have an impact, but I just want you to get these two numbers. America exports roughly 12 to 13% of its overseas sales to Europe. However, we export a third of our sales to Canada and Mexico, the so-called North American Free Trade Treaty, NAFTA. In other words, NAFTA, North America, is much more important than Europe is to us. So, my view is people are vastly overreacting. Bond yields got to 320. John, that's a recession forecast. I'm sorry, 220. That's a recession forecast, a 2.20 bond yield. That's nuts, in my humble opinion. Absolutely nuts. And I think the market correction is, in fact, coming to an end. That's just my own individual view. I could be right. But I think the fundamentals are good. There is no recession in sight. There is no inflation in sight. Profits are rising, John, and energy costs are falling. That is not a recession scenario.
We turn immediately to income inequality. That's much in the news that has been debated for some time by economists, and we welcome Mark Warshawsky of the Mercatus Center at George Mason University. Mark and his colleague Andrew Biggs published a column recently in the Wall Street Journal about income inequality, and here's the surprise. Income inequality and the Affordable Care Act, health insurance in America. That's right. If I understand correctly, income inequality and redistribution are not a matter of cash. They're also a matter of our health care. Mark, a very good evening to you. I know the tax cut is good news, but at the same time, we all need it because health care costs are rising. Do the American people understand that this is a source of inequality? Good evening to you, Mark.
Good evening, and thank you for having me on the show. I don't think this is a well-understood point, and let me just state it right up front. The widely discussed increase in income earnings inequality is caused by rapidly increasing healthcare costs. And it's not because of CEO pay or other reasons that are given by some. So I think that's the fundamental point, which we can discuss in a little more detail, but that's the takeaway point.
Well, so just Mark, let's just lay this out one more step or two. I reread your op-ed piece. Lower income workers are hit harder by rising health care costs because it takes a bigger chunk out of their paycheck. Is that essentially what you're saying?
That is, but maybe we could just take one step before that. Earnings are just part of total compensation. The employer gives a package to the worker, which includes their pay, their take-home pay, but also includes the cost of benefits that the employer provides, which, importantly, in the major way, is owes to health care benefits. And as the cost of health care benefits increases at the rapid rate that we've seen over the last many years, earnings growth slows. Now, that's true on average, but it really hits the lower-paid worker the hardest. Why is that? Because the cost of a health care policy or, benefit is the same for a high-paid worker or a low-paid worker. Right now, according to the Kaiser Foundation, family coverage costs the employer about $12,000-$13,000. That $12,000 or $13,000 is the same whether the worker is making $40,000 or whether he's making $150,000. So the employer has a fixed budget to spread around in terms of increase in compensation, and let's say he gives it fairly, to everybody the same. But as the cost of that health care package goes up, and it's so large, it's going to reduce the take-home pay of the lower-paid worker more than a higher-paid worker. And that's earnings inequality.
You indicate here that an average family health policy in 1999, that's 15 years ago, was $4,200 a year, and now it's $12,000 a year. That's a shocking rise. What did we get for that?
Well, it is a shocking rise, and there are a lot of explanations for that. Some of it is an improvement in healthcare, more technology that's applied to healthcare. I don't think anyone would say that healthcare isn't better than it used to be. But with that being said, there's also evidence that there's an awful lot of waste in healthcare. Some estimates say 30 to or even as much as 50% really is not needed for the health, the actual outcome that we hope for. And, just as the sector has just ballooned, there's a lot of waste.
Does the Affordable Care Act speak to this rise? Is that what it looks to reverse? Is it going to actually give money back to the American family?
I don't think so. When the president first put out, his justification for the Affordable Care Act, that was what he stated was his goal, which was to so-called bend the curve. But more recently, and not even recently, certainly in the last 3-4 years, the justification has changed to increase insurance coverage, because I think a lot of people are doubtful as to whether the ACA, the Affordable Care Act by itself, will bend the curve. There's arguments on both sides, and the Congressional Budget Office really did not give the president's package much credit for reducing costs over the long run.
So another factor is the tax factor, right? In other words, employer health coverage is tax deductible. Individuals are not, and we have very inefficient choices regarding our health care.
Yeah, I mean, I think all economists, and this is across the ideological spectrum, includes people who actually advise the president on the Affordable Care Act. They have been, everyone agrees that the tax deductibility of health insurance as a benefit has created an inefficient system and has really reduced the incentives of all the participants in the healthcare system, most importantly the consumer of healthcare, from being, smart buyers and looking for value. So I think everyone agrees that the tax treatment is part of the problem.
Why don't we just give the consumers, the families, give them the tax credit?
Mark, we're going to let you answer that when we come back. Mark Warshawsky, visiting scholar at the Mercatus Center, George Mason University. Larry Kudlow, CNBC, and Kudlow Radio on the Weekend. I'm John Batchelor. We're talking about income inequality as you've never heard it, as part of the Affordable Care Act. I'm John Batchelor.